All right. Hello, everyone. Thank you so much for joining me real quick. Thank you so much for everyone's comments about the IUL funding your child's college education debt free. I really appreciate the feedback for that. This particular video is going to be kind of a second part to that. I keep getting the questions about buying term and investing the rest. So I wanted to be able to share some ideas with you so you can start seeing some of the uses of different types of life insurance. Today we're going to be talking about the term versus the IUL, some of those uses, and I'm going to give you some examples of some situations that I've experienced with my clients. Kind of draw it a little bit, but hopefully I'll be able to give you an idea of the use of these particular products. So let me go ahead and share my screen. Let's see if I can find it. We have those senior moments sometimes. All right, here we go. So let me go ahead and open this up. I hope everybody can see my screen as it is. Let's see here. Let's see. All right. So that looks about right there. So the index universal life insurance versus the buy term and invest the rest uses, pros and cons by Tony Warfield. The information I'm going to be sharing today is informational use only. A lot of the examples that are used are not real world, but some of the information does come from actual illustrations that were produced in the month of October 2025. As indices change, as percentages change over time, the information that's conveyed in this presentation may or may not be what's going to be available to you tomorrow. So things are very dynamic and things are very actively changing on a daily basis. So again, the information I'm going to be sharing today is for informational purposes only. So please take whatever notes you need, and hopefully it's helpful to you and whomever you wish to share this information with. So, as I've stated before, we're going to be talking about the term, which is basically any policy that you're renting for 10 to 35 years. It's renewable, but it's extremely expensive to renew. So it's better to use the term policy for any kind of decreasing debt, whether it be a mortgage, business loans, educational loans, etc. We're also going to talk about the Index Universal Life policy. This policy is available to you for your entire life as long as the premiums are being covered, right? So the source of that money can come from your premiums that you're paying, or it can come from the accumulating cash that you're going to have in the account. The cash that you're accumulating can be used as collateral later on as you continue to accumulate that, and that money that you're accumulating is offering tax-free access through policy loans where the money is coming directly from the life insurance company. Collateralized money from your account makes that possible. You're going to hear us talking about key riders like living benefits, critical, chronic, and terminal illness. This is basically you getting paid while you're still alive. It's not available with your employer, so you definitely want to pay attention to that. If you have a policy, you want to check your policy as soon as you can to see if you have living benefits available. So going a little bit deeper on the living benefits, critical illness, certain conditions, major heart attack, stroke, major organ transplant, paralysis, amyotrophic lateral sclerosis, arterial aneurysms, central nervous system tumors, significant burns, end-stage renal failure, or invasive cancer. If you were to have that type of critical illness, depending on the severity, you can make a claim and get money while you're still alive, right? And they use that money to get you back on your feet, get you cured, get you moving on. Terminal illness, if you're expected to expire within 24 months, the doctor certifies this, they can pay you as much as the entire amount of your death benefit. Now, one of the things about the death benefit, and I'll say this about the chronic illness as well, the money that you get from your policy, if you're using that money to get you better in the United States, I'm sorry to tell you that if it's a terminal illness, chances are it could be mortal. But there are other places that you can go where you can use that money and actually find a cure for you, and the money that's left over is available for you to continue to enjoy your life and actually increase your lifestyle, which is great. So chronic illness, you may accelerate up to 100% of that. It's for taking care of you if you cannot do 2 of your 6 activities of daily living, eating, bathing, dressing, etc. And this is important because if something happens to you and you cannot produce and you're the primary breadwinner, you're going to want that money available to make sure you continue to cover the the cost of living. So again, this is not available for employer-sponsored plans. So it's important to answer these two questions, right? Who is the policy for? What is the policy for? And you'll find that once you have these two questions understood and answered, it'll be a lot easier for you to make sure you get the right policy for you, regardless of whichever carrier that you choose to work with. So I want to tell you about Amune. I like the name Amune a lot. I don't know what it means, but I love it. So Amune is 5, male. His parents wish to have life protection for Amune that also accumulates cash that can be available to borrow against when he gets ready to go to college, 18. This money cannot be subject to high risk options because they can't afford any losses. They got about $100 to invest in this every month until he turns 18. So let's take a look at what that looks like. So as the money continues to grow, Amune has an opportunity to really have some protections in place. But to be clear, term policies are not available for minors. So the only option in this case you would have would be to get a permanent policy, whether it be a whole life, or whether it be a universal life, or in this case, an indexed universal life. And you can see that at age 5, he can get some pretty decent coverage, $200,000. You can see where it says option B switching to A. That's basically an increasing death benefit, which levels off after 45 years of paying $100 a month. You can see the riders, overloan protection, OPR, critical illness, CIR, terminal illness, TIR, and chronic illness, CHR. You can see here where it says no lapse premium, $23. What does that mean? That means for about 15 years, if you're paying $23 in this policy will not lapse, right? But after that 15 years, you're going to need to pay a little bit more than $23 to make sure you keep this policy in force. At $100 should not be a problem, right? So let's take a look at the next option here. So Amune, $100, parents have been paying that for 45 years, right? You can see that there's 3 primary columns here: guaranteed assumptions, non-guaranteed for 4.5%, non-guaranteed for 6.72%. So guaranteed means this is the money that's going to be in that account, period. Doesn't matter what the market's doing, up, down, backwards, whatever. We know that money is going to be in that account from now until the end of time, right? At least for Amune. And for the non-guaranteed, chances are 4.5%, usually a flat rate. You're going to see a pretty decent return. So you see the account value and you see the surrender value. The surrender value catches up to the account value because this is a long-term product. The surrender value is the amount of money that you will get if you try to surrender this policy before the account value and the surrender value are equal. In this case, about 15 years. The surrender value / account value is added to the death benefit, which is why the death benefit continues to increase. Now you can see over there at age 50, the premiums are discontinued after age 50, which gives you a pretty decent return in each year. And you can see that the returns continue to grow even though the cost of insurance continues to increase. So if you look at age 50, you can see that the guaranteed amount of money in the account is $29,067. Predicted for 4.5%, 328,000 with 128,000 in the accumulated cash. And then you have 248,000 in accumulated cash with a death benefit of $473,000, which is absolutely phenomenal because you know that inflation increases. So having an increasing term, increasing death benefit will make sure that the coverage is available for Amune long after he graduates college. Now, we talked about using the money for college. So by the time Amune turns 18, it's about $17,200, right? So no, that's not a whole lot of money, but you're looking at $100 being saved for 13 years, and you still got a pretty decent amount of money there. That money can be used to cover the first 2 years of any college or even a university. And chances are that if you were to get financial aid, the financial aid is actually at a percentage that's lower than the money that you'll be getting back with your IUL on average. So you can get FAFSA or financial aid, and say Amune wants to go get a master's degree. Add about 8 years to that, from 18 to 26. By the time he's 26, you're looking at about $40,000 in the account. That might be enough to make sure that Amune graduates from college debt free. chances are it won't be, but it'd be closer to debt free than having a full amount of whatever bachelor's or master's or even a doctoral degree, right? So that's great. If you look at what happens with, say, he decides he wants to retire at 50, right after the last payment is paid, you're looking at an additional $248,000 being available. Maybe 60, where it's $478,000. All that's being added to an increasing death benefit, even though the premiums are no longer being paid. This is a wonderful opportunity for you to not only make sure money is available for Amune's college education, but also have additional money available for Amune's retirement, adding to any other monies that might be available, because we know Social Security ain't looking so good right now. So let's talk about Keisha real quick. So Keisha is 22, female, just graduated from college and got a job that does not offer life insurance protection. Her job pays just enough for her and her son to live modestly. She has no other source of income, so if something happens to her, she would not be able to take care of her responsibilities and her son. She's got about $35 extra every month to be able to cover the cost of insurance. Now, that being said, if she's only got $35 and she needs coverage, we need to start looking at a way to make sure that we can protect her with the money that she has available. So, as money is tight, creating financial stability is paramount. Keisha's income does not allow her to save money fast enough to protect her and her son financially. And if she has something happen to her, what's going to happen, right? Medical insurance does not pay for the rent, doesn't pay car notes, cell phones, gas lights, and it certainly ain't paying for these eggs right now or that gas. We don't want to talk about that. So if she were to get a convertible term, she can get the living benefits protection. She can have the death benefit that's going to be able to take care of her for as long as she's ill. And what's so great about that, if she converts the policy before the deadline, she'll have permanent coverage for the rest of her life, which is great. So you can see that because she's so young, she only has to pay about $35 a month for $556,000 worth of coverage. But of course, when she converts that, the death benefit will decrease, right? And the premium might go up a little bit slightly, depending on how much coverage she wants to maintain and how soon she does it. Because if she's still pretty young, the premium won't go up that much. Now, the way that the premium is broken down with a cash value life insurance policy, in this case an IUL or an index universal life policy, a portion of the money is going to the cost of insurance, the rest of it is going to cash accumulation. So when you convert this policy to a permanent policy, some of the money is going to go to the cost of insurance, the remainder is going to go to the cash accumulation, as it did with Amune's example. So let's see how that looks, right? So Keisha has a term policy. It looks like it's about 20 years. If she converts that within 15 years, she'll have permanent coverage and financial protection for the rest of her life. But if she neglects to convert that policy after 20 years, you can see after paying $8,400 for the total 20 years, the next payment to be able to renew that is going to be over $1,900. Sorry about that. $1,900. Now you can see that every year after that, the cost of insurance is going to continue to increase. And after age 30, or probably after 51, $30,000, 61, $79,000, 71, $199,000. So when I tell people that term is actually more expensive than permanent, this is why. You might get away with low fees earlier, but if you try to renew that policy, it's going to be exceedingly expensive. So you definitely want to convert that to a permanent policy, primarily because retirement income is going to be, questionable. Medical expenses are going to be higher. Long-term care expenses are going to be higher. So we want to make sure that we convert that when we can, so we don't have to worry about suffering some of these exorbitant costs later in life when we have limited income. So I want to talk to you about Kemper. Kemper, 37, non-binary, recently had sexual reassignment surgery. As Kemper wants a new life, Kemper purchases a new home for $850,000 that will need to be protected for the life of the loan. Kemper got a 30-year fixed mortgage with homeowners insurance attached. This protects the bank, but Kemper will not need financial protection as well. Kemper will need financial protection as well. Kemper will need to protect the home until the mortgage is paid off, and Kemper will need lifelong protection to cover expenses medical insurance will not cover in the event of an illness. Now, you understand when you have sexual reassignment surgery, there are medications that you have to take for the rest of your life. So we want to make sure that those living benefits are available to protect Kemper just in case something happens later on. So Kemper also wants a low-risk investment option to collateralize when ready to purchase additional homes. Kemper has about $1,000 available each month to be able to take care of that. So with that $1,000, there are a few things that we need to unpack here. So again, we want to talk about buying term and investing the rest. So let's see what that looks like real quick. So buy term and invest the rest, pros and cons. Pro, low cost, high death benefit. Pro, living benefits if you got it. Con, you're going to lose the money that you invested, or you possibly can lose the money that you invest. And after the policy expires, there's no coverage later on in life. If you have that increasing term, you might have coverage, but how much is that coverage going to cost? And again, I ask you to stop right now and take a look at what that looks like, right? So we'll talk about that later on. Buy term, invest the rest, then convert to permanent. So pro, low cost, of course, conversion, recover the premiums, living benefits, but a con, you could lose all the money, right? Portion of the money right before you really need it, right? Con, conversion does not recover any of your investment losses. So something to consider. And then you have buy term and an IUL. So a pro there, low cost asset protection. You don't need the asset protection once the asset has been paid off. Another pro, IUL offers a death benefit protection with cash accumulation, not subject to market losses. It's not, you get tax advantage use of that money through policy loans. The term can be converted to a permanent, adding additional coverage for you. And of course, you got living benefits available. But a con is the premium paid into the term is forfeited if you don't convert it in time, right? So there are pros and cons to everything, but I think that in this case, Kemper is going to need a policy to cover his house and a policy to cover him. So how does that look? So if he were to buy term and invest the rest, he can get this term policy here for about $122,000, $850,000 coverage. It's convertible inside of 20 years, which is great. Term policies are best used to protect assets. This includes your house, properties, businesses, etc. Term policies are also very good to get you short-term coverage while you're getting your money right as, it's the same as with Keisha. Yet without a conversion option, you will ultimately need to get more coverage. Again, if your life insurance company does not offer you a term that is convertible to a permanent, that policy is going to get extremely expensive when you need that policy most. If that policy does not have living benefits, then you're basically going to be paying additional monies to make sure your beneficiary has money after you expire. Reconsider. Without a conversion option, you will ultimately need to get more coverage later or renew your term at a very expensive premium. Term policies are not the best option to protect you for life. I say that again, term policies are not the best option to protect you for life. Why? Because less than 1% of all policies actually pay out, regardless of the carrier. Check on it. Look it up, right? This percentage increases when you add living benefit claims, as living benefits paid you while you're still alive. So if your policy does not have living benefits and you bought a policy at age 20, chances are that policy is never going to pay out for you or your beneficiary, because if you're 20 and you got a 30, 35-year term, you're still in your 40s or 50s. You're still in your 30s, 40s, or 50s. You're still healthy. Chances are you're not going to need that policy, right? So with Kemper having the term provide protection for 30 years, it makes sense. So if the term offers conversion to permanent, Kemper can get credit for the premiums paid and have coverage for the rest of their life. Depending on when the conversion occurs, the premium and or the face amount will need to be adjusted. So again, Kemper has about $1,000 minus this $122 for the term. That means $878 that Kemper can invest in whatever they wish, right? So let's take a look at another option. So what happens if you convert it, right? So conversion period, convert before a deadline, additional money can be used to overfund the IUL, which is great. This is important. If you have a term, stop this video right now. Put it on pause. Go find your policy and find the payment illustration, your premiums. Find a list of your premiums as it's shown how much you're going to be paying every year. Examine that. I need you to do this because if you notice, you're going to have some steady payments in the earlier years, 37, 47, 57. Looks pretty good, 1464, $122 a month, no problem. But as you get older and you start needing additional funds to be able to take care of you, that's about when your term policy expires. And when your term policy expires at age 66 and you need additional monies at 67, your premium goes from 1464 up to $18,468 in this particular scenario. So I don't care which carrier you're with, no matter how great they are, if you have a term policy that terms out and you try to renew it when you're much older and much sicker, it's going to be much more expensive. It doesn't matter who the carrier is. So we want to make sure that if your policy can be convertible, that you convert it. However, if your 20-year or 30-year term, increase in term has a jump like this, you want to seek additional options. If the conversion is not an option, you will either lose your protection when you need it most, or you will lose your retirement funds to pay for that policy that you will never be able to use. I hope that's stuck. Because remember, retirement income is going to be limited. You're not working anymore. But medical bills are going to go up. Long-term care bills are going to go up. The cost of food is going to go up. Everything is going to go up, right? So if everything's going to go up, the last thing you want to do is pay 5,000% over what you were paying before for your life insurance policy to make sure your beneficiary gets the money. I'm just saying. So let's take a look at another option. So you have the IUL. I'm a big fan of IULs. I got a couple, like them, right? So let's look at the indexes, right? So the way the IUL works is it actually puts money and hedges that money against the market. The money is not in the market. It's hedged against the market. So what does that mean? So if we take a look at a good example here would be Morgan Stanley, right? Over the past 20 years, Morgan Stanley's stock has about an aggregate of 7.35%. The return for the IUL was about 10.85%. Why? Because if you look at the market, when the market was going up, the market was going up. But when the market tanked, it tanked pretty hard. If you look at 2008, minus 20%. If you look at 2011, 7%. If you look at 15, 4%. If you look at 22, that's 17%. But you'll notice that with the IUL, 2007 locked in at 0.25, 2008 locked in at 0.25, you had 2011 locked in at 0.25. So what does that mean? So if you look at 2008, 2007, 2008, 2011, where you had deficits in your money in the stock market, your money either locked in with your IUL or it grew. It never suffered any losses. So right after the housing market crash, let's look at if you had you started out with $100,000 in 2008. By the time 2008 was over, you were down to $82,000, whereas you had about $103,000 in your IUL. In this example, not too bad. You fast forward a couple of years, yeah, you had some pretty decent growth with your market fund there, $107,000, $108,000. But because of this particular index earning 105% of whatever the positive amount is, you got about 147,000 total by 2011. The next time we had a crash was 2015, 2016. You went from 167,000 to 160. Well, your money locked in place with your IUL. So instead of taking a loss, you got about a 0.25% return. And then, of course, in 2018, 224 versus 336. 2022, right during COVID, 312 versus 585, right? And then, of course, you look at 2024 now, like 413,000 versus 785,000, which is almost double, right? And what's great about this is with your money that you earn, even though you lost money, you still got to pay capital gains on any money that you actually accrued. versus tax-free access with your IUL. And your beneficiary after you expire gets the benefit of that death benefit tax-free, right? So where you put your money matters. In this case, the rabbit was going slower than the turtle, right? So key point, if you cannot afford to lose money, don't invest in high risk options. It's important that you understand that, because if that money is gone, you can never get that money back. You can recover from losses, but you cannot recover losses. So once that money is gone, that money's gone. So let's take a look at what that means, right? So to be fair, when the IUL, unlike the stock market has a gang of different options that you can select from, right? With the IULs, depending on the carriers, all the carriers don't have the same options, but every carrier has limited options. So there's about 6 or 7 options available with this particular carrier's IUL. You're looking at, what is this? Dow Jones, right? You're looking at the Barclays. You're looking at Morgan Stanley. You're looking at BlackRock, Gold, and of course the S&P 500. So if you look at the general geometric average or the aggregate, the market did pretty well on your U.S. real estate daily risk control. Didn't do so well against Barclays because of their 200% participation rate, basically doubled whatever you get. Morgan Stanley did better for the IUL. What's that? BlackRock did better for the IUL. You have S&P 500 did slightly better because of the caps that you have with the S&P 500 being so low. Then of course the gold is slightly better because of the caps are at 16%. But the bottom line is you get a very, very consistent return with the IUL because you don't have to worry about market fluctuation. You don't have to worry about suffering any market losses. Now, I will add, if getting matching funds from your employer-based retirement plan, take the full match and invest your overages in a private plan that goes with you when you leave that employer. So when you got that 401k, that 457, 403b, TSP, SEP IRA, or whatever. If they're offering you 2, 4, or 6%, take it. But if they're offering you 4% and you're putting in 10%, that means 10% of your money is subject to market fluctuation. You don't want to put your retirement plan, especially when you're older, in a plan that can possibly wipe you out, because that happened to me 2000 and 2008, and many people suffered from that. Because you got to remember, the money that's in your employer-based plan is qualified. That means it has not been taxed yet. So if you end up losing 50% of your face value in your 401k, and when you retire, you're going to lose another 40% of that, can you live off of 60% of 60% of what you got left over? If the answer is no, then either you're going to go back to work again, or we need to start looking at some better options. And that's why it's important to be able to have an advisor earlier, whether it be an insurance advisor, a CPA, certified public accountant, or a CFP, certified financial planner, someone that's going to be able to help you understand the differences between these accounts to make sure that you are protected earlier so you don't end up losing your money when you need it. So I want to be able to cover a couple of more things before we go. I hope this was clear, but I want to be able to cover a couple more things before we go. So I have some favorite carriers: Fidelity and Guarantee, National Life Group, Corebridge, Emeritus, Principal is for group life, Standard, Equitrust, whoever, right? We got a lot of different carriers out there that offer some really great products. But when it comes to the IUL, it's important that you make sure that you have a policy that allows you to give your wealth to your beneficiaries, a policy that accumulates cash, that offers you tax-free access, it has living benefits, and any additional riders, whether it be spousal term, level term, child rider, waiver of monthly deduction, accidental benefit, like whatever, right? You want these additional benefits because it makes it a better policy, right? So starting with the face amount and increasing benefit is the total amount of insurance you will actually pay for. The cost of insurance rises, less money will be going to your accumulating cash account. Pay all you can early. The accumulating cash can be accessed tax-free through policy loans using the carrier's money. your money continues to grow with uninterrupted compounding interest. Living benefits allows you the access to your death benefit while you're still alive. So we definitely want those added living benefits, right? So why is this important, right? When you look at your term policy, it's not accumulating any cash. So because you're not accumulating any cash, having the increasing term is good, but having the money in the cash accumulation portion of your IUL, in my opinion, is better. Why is that? So say you got about $100,000, right? 100,000 bucks. What does $100,000 look like in 25 years? This is important. What does $100,000 look like in 25 years? So what you get today for $100,000, if you add on inflation, which averages about 3.2% every year, today's $100,000 is $220,000 25 years from now. So if your policy is not keeping up with that, if your savings account is not keeping up with that, if your investment account is not keeping up with that, you are losing money. And if you don't have the protection in place with your life insurance policy, you are possibly going to lose more than that, right? So let's see what we're talking about here. So again, I want to talk about the no lapse premium. As long as you're paying the no lapse premium, you're good to go. I also show you how to max fund a policy. If you're max funding your IUL, and this is another presentation, I've already covered this already, but I just want to reiterate it. When you're max funding your IUL, the cost of insurance in this particular situation might have been $167 for 15 years. Of course, it goes up, right? But for the first 15 years, you're looking at $167. If you are max funding it, that means you're putting as much money as you can in this case, $1,179, more than $1,000 is going to the accumulated cash for the first 15 years. That's huge, right? So if you're putting money away anywhere and it's earning a decent average, your IUL not only is accruing uninterrupted compounding interest, but it's also got a death benefit available to you just in case something happens to you. How about that? So I wanted to talk about the increasing death benefit. So increasing means the death benefit's going to go up. So that means the cash accumulation is added to the death benefit. So you're looking at option B, 175,000 in this case, plus the cash benefit is 225,000. Option A means that you're going to be paying a level death benefit, which means as you accrue more money in the account, you'll be paying for less insurance. Even though the cost of insurance is going up, you're paying for less insurance as your account value increases. So in this case, the death benefit is $175,000 minus the cash that you have in the account. You're actually paying for $125,000 worth of coverage in this case, but your total death benefit is $175,000. Because you're paying for a steady amount of coverage of $175,000 in option B, you have $50,000 in coverage, your total coverage would be $225,000, right? Until you pay your last premium. Your age, financial goals, and funding amount weigh in. This is what makes an IUL a great way to grow your money. So I wanted to talk about policy loans. Now, I don't do variable, but variable are available with some carriers, looking at about 5.5% on average max, right? Might be as high as 8% in some fixed loan situations. But this is what's great about that. You can try to get a loan from your bank. The loan might be higher depending on your credit, but this money is yours. This money is already in your account. So if you collateralize the money that's in your accumulated cash account, you can borrow that money, and if something happens and you can't pay it back, it just gets deducted from your death benefit. How about that? And your beneficiary still gets the net amount tax-free. Don't have to worry about paying any taxes on that. And if you do pay the loan back, you're paying yourself. You're not paying some bank or anyone else. That money's going to you, which is great. I love it. So let's talk about some of the guarantees. Now, I talked about the guaranteed assumptions, the alternate, and of course the current. But I wanted to make sure you are aware, even with guaranteed growth, the policy requires an annual interest rate that will outpace inflation and the cost of insurance. Showing the current value conveys the predicted growth that will help your money grow faster each year. So we want to talk about the minimum, which is the 0.25% that we explained earlier, right? I keep doing that. I'm sorry about that. right? And then of course at 4.5% flat rate, and then at 6.72 is a particular predicted amount according to the past performance. Now, past performance is not a perfect indicator of future performance, but if everything were to remain equal, your 6.72 jive, and then your money will be able to grow at a rate that's faster or that outpaces inflation. So let's talk about the indexes. One drawback to having the IUL, as I stated earlier, there are limited indexes, but those limited indexes usually work pretty solidly. You have cap rates, which cap you at 11.5% in this situation, and 16% for gold. You have a spread, like you have with, I think that was with Barclays, 3.25%. And then, of course, you have participation rates of 105 with Morgan Stanley, whatever the market did times 105%, or what's that, Dow Jones, real estate, 10%. Oh, I'm sorry, BlackRock 180%, whatever the market did times 180%. So those look pretty good. It's good to diversify the investments to make sure that your money is always growing at the fastest rate possible. But we do what are called policy reviews. And every year, depending on the performance of that index, we can change your allocations to make sure that you're keeping up with the trends, which is great. So getting a closer look at it, the yearly policy review is essential in maximizing the growth of the accumulated cash in your IUL. Underperforming indexes can be switched to higher performing indexes each year or biannually. Remember, life insurance is a long-term financial tool. Sometimes you may have to just ride it out, just like you do with your 401k or your 457, 403b, or otherwise. So I wanted to talk about some comparisons real quick. So I've seen some of those high yield savings account offering as much as 5.84%, which is pretty good. So you compare that with your IUL, it kind of jives. Even though the IUL outpaces that savings account is still doing pretty good. The only difference, the real difference, is you're paying capital gains on the money that you're getting in that savings account because it's taxable income. Yeah, that happens. But the money that you're growing into your IUL, that money does not get taxed until it's accessed. And if you never access it and the beneficiary gets it, there's no taxes paid on it. And again, you can borrow against that for tax-free access and never have to pay taxes on it at all, as long as you maintain within the IRS guidelines. It's good, right? So then this is kind of busy. I know it's kind of busy, but let's see if we can work this out. So the maximum premium allowable is 14 grand, which is 1100. I have that paid out to age, this is actually mine, right? So I have that paid out to age 80. So the last payment will be about at age 80, about 14,000 at age 80. But then payments to me start at about $90,000 at age 81. So the last payment will be $14,000 at age 80, and I got 10 years worth of payments of $90,000 coming back to me. So this will be an additional source of income for me. So me being a veteran, that's a source of income. Social Security, if it's available, that's going to be an income. My business, everything. So there's a good chunk of change that's available. So a properly funded IUL can be structured to allow an additional source of income when you retire. The premiums can be stopped. The accumulation will cover the cost of insurance and outpace inflation. The longer you wait to use the fund, the more money will be available for your retirement. The more aggressive you are, the more money you will have. This can even happen for those late starting their retirement savings. So you have those catch-up plans for your 401k. What is it? $8,000 if you're over 50, and then a total of 31,750 for various reasons. Your IUL will allow you to have uninterrupted amounts of money that you throw in there, as long as you maintain within the IRS guidelines, which is huge. So I wanted to talk about this again. So the final yearly payment was at 90 in this situation. That's the payout to me, right? So if I live longer than 90, I would need to exercise one more of my policies. Social Security may not be available, so by the time I reach age 90,000 will be equivalent to today's $40,000. So basically, I'll be getting paid $40,000 at 3.2% annual inflation. Clearly, this will not be enough to live on, but it's a great supplemental income going with my Social Security and everything else. The total premiums would have been approximately $348,600 versus the total payout from my life insurance policy of $900,000. So I paid 3.5, but I got back 900,000 back. That's not bad. So after the final premium is paid, the accumulated cash will cover the cost of insurance. Switching options from an increasing death benefit to a level benefit will result in you paying for less insurance units as you paid less with one less S. Sorry about that. Insurance units as the account value continues to grow. If you choose to continue making payments after changing options, this will be a limit on, I'm sorry, there will be a limit on the amount paid to prevent the policy from becoming a modified endowment contract, and we'll talk about that in another presentation. So, overfunding your policy. This is pretty important, right? So if you look at all the way over to the right, you can see the cost of insurance is increasing. But even though the cost of insurance is increasing, the money that you're earning in this account is by far outpacing that. That's why I get so excited about the IUL, right? So you're looking at your death benefit. This is the percentage return that you're getting on average. The first year obviously is insane, but as you get a little bit older, what is that? 6.355, and you're paying how much? Just a few $1,000s a year. So this is why it's so important to max fund or overfund the IUL or IUL early, so later on you have so much compounding interest and so much money enjoying that compounding interest that you far exceed any expenses, including fees that you might be getting later on. So the younger you are, the lower the cost of insurance. The older you get, the higher the cost of insurance. The cash value is more likely to increase rapidly with the compounding interest and the majority of your payment going to cash accumulation. Later, the cost of insurance would be higher, but the account value's compounding interest will outpace the cost of insurance and inflation. Overfunding the policy earlier will ensure maximum growth later in the policy. If you choose standard funding or underfunding, the cost of insurance is likely to catch up with your payments, requiring additional funding, or the policy could lapse. And that statement right there is why you get so many people that says the IUL doesn't work, because if you're not funding it properly, of course it's not going to work. I'm just saying. So the last thing I want to cover real quick, a couple of last things, right? Talking about the accelerated death benefits, right, or the living benefits. This is what the payments would look like depending on the severity of your illness and how old you are. So if you're talking about a critical illness and you're age 70, you get as much as $368,000 for this particular policy. Now, this policy initially started at $175,000, but because it's an increasing death benefit, that money is available at age 70 for category 4 illness, $368,627 for age 80 and on. You have terminal illness, which pays everything out by age 70 more by the time you get older, and chronic illness, you're looking at age 80, 627,410. So keep in mind that not all carriers are the same. Consult your financial professional for assistance in selecting the right life insurance carrier for you and your needs. As you age, certain living benefits may not be offered by all carriers. That means not all living benefits are available because your insurability decreases as you get older. So that's why it's better to jump on it sooner. Your agents may be contracted with multiple carriers. Reviewing the options offered by each carrier will help you get all the benefits allowed. It's your money. Get all you can for it. Make sure you are getting regular checkups, though. A healthy mind, body, and soul is priceless. Living benefits are great, but not nearly as great as being healthy. So it's important that you take a look at this. And, before I do my closing remarks, I really want you to see this one more time. I want to actually close with this in your head. Let me see if I can find what I'm looking for. Okay, going back to this page right here, right? So we talk about buying term and investing the rest. One last thought I want to have about this particular page. If you don't know how to invest, and you're putting your money into a stock market, that whether it be an electronically traded fund, ETFs, mutual funds, or whatever. Mutual funds can be a little bit scary because they actually put money in funds that benefit them. They don't put money in funds that benefit you. ETFs, you got to watch. Regular stock, individual stocks, you got to watch. But if the money is in your IUL, that money is protected. You don't suffer any market losses, whether it's money being used in an ETF, a regular stock, or a mutual fund, right? The goal is not to lose any money. So if you got your money in IUL and you're not that, stock savvy, you can be able to rest assured that you're going to at least be able to maintain the money that you're putting in the account and not have to worry about any market fluctuation. If you have additional money that you can play around with, absolutely put that money in the stock market, take advantage of it. But you need to monitor the stock market and whatever stock that you have your money in so you don't suffer any losses. Because hear me when I tell you, I just took a vacation back in 2000, and when I got back from vacation, 50% of my money was gone. So it is an active job, if you would, to maintain knowledge about the current status of your accounts. If you're not doing that, then you really will have some challenges with buying term and investing the rest. So with that, I want to make sure that I share a little bit of information. You're going to have some questions. So please shoot me an email at info@warfieldlegacy.com. Visit my website on www.warfieldlegacy.com. If there's any questions that I can answer for you, I do this for free. This is fun. I'm literally just chilling at home recording this video. Forgive me for it not being so polished, but I hope the information has been helpful to you. And with that, I look forward to seeing you at the next video. Live free and God bless. Oh, shoot, I forgot to close the screen. With that, live free and God bless, and I look forward to seeing you at the next video. Take care.